Sound.
Okay, you are now recording.
Okay, good. Okay, well, welcome to another exciting meeting of Micro Giants. We're going to really discuss a pretty serious topic, which is also in the news. Many times we have a news section, but today we're just going to pretend as though our news item is inflation, and then we're going to talk about inflation. So the reason I sort of changed my mind late in the game on this particular topic, and the reason is that, of course, we hit sort of an all-time, a 40-year high this last week. And there are now people who are beginning to understand that this is going to be with us for a while. So I thought it made a lot of sense to be able to go through some of this information and talk about inflation, so that all of our micro giants and other small businesses can really have some resources to kind of figure out what to do about this. I discovered, I was listening to a guy on Bloomberg, and he had said, well, all of the people who've actually been involved or actually know about inflation are all dead now. And so he was one of the ones, an old guy who was aware of it. And I guess I'm one of those guys too, because I was actually in business and had decision-making responsibility for several stores, seven stores. And I had to deal with inflation person to person. I was a pretty young man in those days. And I didn't deal with it nearly as well as I could deal with it today. So I think, so we'll jump into the subject here, but I hope this will be useful. Let's see, we'll start the presentation. So what really is inflation after all? And it's got a couple of characteristics. Basically what it means is that the dollar losses will lose its value over time because it buys less from one year to the other.
Ron, real quick, are you going to record this one?
I thought I started it.
You're being.
Yeah, we are.
Okay. I see it as recording.
Okay,
Yeah,
I see it now.
It is.
I apologize about that.
And then, so annual inflation is at 8.5%. The last time it was 8.5% was 1981. I can remember that pretty well. But what I remember even better was 1980, when it was 14.4%. Pretty outrageous inflation rate. And I think you remember that too, don't you?
Mm-hmm.
And you were in business too. You're not as old as I am, but you were in business.
That was the first year that I was in business.
The first year, okay. So
over here.
Here in the United States, right? Basically interest rates were pushed up to 21%. I was lucky because I had locked in a loan, and it was an SBA loan. It was locked in and I didn't have escalations, but I had competitors that had interest rates that were floating, and literally it put them out of their misery. Of course, that helped me. And so that was one of the lessons that I learned. So how do you tame it? How do you solve the problem? And of course, that's an economic question, and there are we could really discuss that for some time. Nobody can agree on it. I've listened to 10 top economists talk about it. There's only one way we know works, and that's a recession. So the issue here is, how do you really strategically plan your business when you know that the only way inflation will go away is with a recession? That's kind of another subject. What we're going to talk about is, before we have a recession, and we right now have a wonderful economy, the consumer is healthy, there's over $1 trillion of savings that consumers are sitting on. Demand is still high for goods that we can't get. So nobody believes we're ready for a recession. Well, a few do, but most do not think we're ready for a recession. So if we're going to, that means there's a good possibility that we are going to have ultra high interest rates or we're going to eventually go into a recession. They've never tamed inflation without having some kind of a drawdown in terms of inflation. So what does this kind of mean? Whoops, sorry. Basically, if you look at the top chart here, you can see that a dollar at 8.5% is next year is only going to be worth 91 cents, or $100 is going to be worth $91.50. And so the increased cost, if you buy something for $100, next year it's going to cost you $108.50. So that's the impact. The chart on the left shows you that relative value difference just in chart form. And then on the right, you can see that in 10 years, oops, excuse me again, in 10 years, that this is going to go down pretty dramatically to the point to where it's going to be worth less than half in 10 years. And you say, well, 10 years, how could that really be? Well, or can it last that long? And the answer is you generally, when we go back and start looking at inflation, they start the comparisons in the late 60s. And they don't end until 82, 83, when the big recession came, very intentionally. And that was done when Reagan took office, or just prior to him taking office. And the Fed had something to do with that. Economists had something to do with that. Carter had something to do with it, and Reagan clearly had something to do with that. So we're talking about a period of time well over 10 years. So 10 years is not an exaggeration. This could easily last 5 or 6 years. And in 5 or 6 years, you can see that you're going to have maybe a 50% valuation by the time something happens. So how do you handle this? And it's really not quite the same as you would do normal business. So I thought I'd throw some stuff out to show you how I believe that this can be handled. Wanted just to mention briefly the CPI versus the trimmed mean CPI versus the core CPI. These are different measures of the economy, of inflation. It's important to note, and by the way, down at the bottom, I know this is too long, but if you go to, I really like the Brookings explanation of this. So if you go to Brookings EDU and you just type in how do the underlying inflation measures compare, you should be able to get this chart and the full article that goes with it. But you can basically see how these different charts have gone up and gone down.
Question for you.
Yes.
Consumer price index.
Mm-hmm.
What does it include? Is it, like inflation is a subset of those things that we purchased. Is the CPI a subset, or?
Well, that's a hard question to answer.
Okay.
Because they've changed it. It used to be that really represented inflation back in the 70s, but they changed how to calculate it. And the government hasn't been completely forthcoming about this necessarily. They still call it the CPI, but it measures it softer than it did. So some say that an 8.5% CPI today, which is supposed to be the core inflation rate, it's food, gasoline, et cetera. And they do measure it several ways, but that actually it would be more like 11.5 or 12%. And so there are these different versions, and you have to be kind of careful about that comparison. Now, if you're just trying to understand what's the inflation rate, you could say, well, the inflation rate is pretty close to the CPI.
Okay.
I think for normal business. However, if you're going to tie contracts to a CPI, you better study this page that I've loaded up here very, very carefully and understand it very well. Because if you have and we used to write contracts with inflation factors in them. I don't know, have you run into one recently where they've done a CPI?
Not recently.
But I mean, we used to write them so that they would say, increased rent by inflation each year for X years.
So we run our contracts now with a cost of living indicator, which is and we just put 6% on it.
Oh, okay. So you just plug it in.
We just plug it in, but we call it the cost of living.
Right.
It's a variant of a
And does
CPI.
anybody push back on that except
No.
for other than me?
Nobody.
I did.
Well, maybe you did, but
Because I remember this. and I had leases. I had leases, 7 leases with escalator clauses in them.
Sure.
So, and some of the leases were 5, some of them were 10 years long. So that was a big deal.
Yeah, if you have a 10-year lease right now, fixed price without an adjustment,
You got a nice deal.
you got a nice deal.
That's exactly right. Exactly right. Okay, so let's talk a little bit about some of these main issues here. Basically, we've got 3 categories here, I think, that we can affect. One is expenses. We have both controllable and uncontrollable expenses. And you need to know and understand when and how they are controllable. Obviously, we have revenues. Now, revenues are a good thing if they're inflating in this regard. If you can maintain your growth of expenses and inflate your revenues, then what happens is that your break even begins to create more margin dollars for you. And now you're in a pretty good situation. And that really is the tension here, which is why you want to work really hard to negotiate prices for any materials that go into your product or any products that you're buying, to try and control it on the front end and then allow your revenues to go up. And then, of course, capital costs, if you're going to be buying equipment, plant, doing tenant improvements, or doing other investments, you really want to carefully consider when to make those investments, because making them now might make more sense than making them later.
Yeah.
So you should be spending all of your research, all of your repair money as soon as you can. Get it done, get it over with, so that you don't have to spend more for it later. That's the concept there. And I'm starting to do that at my new house right now. So all of the expenses can be controlled. And I've had argument with this from time to time, and that's because what's happened is the decision has already been made to take on, say, a utility bill. But my point here is that you make a decision to bring on an expense at some point in time, and that's when you control it on the front end. Once you have committed to have utilities, a certain kind of utilities, you're pretty much at the mercy of whatever they decide to raise the price to. Now, you can mitigate that by putting in more insulation or changing distribution or locations. I mean, you can mitigate that, but they're hard to do. And it's questionable as to whether or not it would really give you any real payback. I think obviously you can get some payback, and you want to study those in order to determine if you can do that. But many other expenses you can't really control. But you can do things like buying things in quantities so that you can have a 2-year supply instead of a 3-month supply. All of this is mitigated on having the cash. If you can invest the money now, then you can begin to play it as if it was a commodity market. So you want to buy low and use it down the road. When you use it, you can build that into your prices, or you can choose not to increase your prices because you have input costs that are lower from a previous time period. Payroll is another thing that you can control and is a very big deal, but it's not easy to control. Growing your revenue, then, the question it really is are you going to increase your prices or not? And many of them, many people will decide not to do that, and they get themselves in a rough spot. We'll talk about that more. But over time, you'll find that your revenues will increase from 40 to 100%. And so we went through those numbers already. So you're going to have a lot bigger increase in revenue. Now, don't fool yourselves. That may not be real growth. That may be all all inflationary growth. So you need to have, if inflation is 8.5%, you need 10% to have real growth, right? And so you want to keep that in mind all the time, is that don't just be happy with 5% growth when inflation is 8%. You're going backwards there.
One of the things you got to figure out too is like inflation affects the things that you do buy and you pay. It doesn't affect your profit margin or differential. So, if you've got a true 8.5% increase, then you put up your base of operations by 8.5%, and maybe you don't put up the margin as much. So you don't put up the whole thing.
Well, right, exactly. And therefore you're going behind. But if in fact you're 8.5 and 8.5, you're going ahead,
right?
Because your overall marginal dollars are more. So you should be making more dollars, not much, but a little bit. I mean, ideally what you want to do is keep your expenses to 7 and allow your revenue to grow at inflation.
Right.
But as we'll talk about, the question is, should you do that or not do that? So do we pass this along or not? I think that's a big question, and we can spend some time talking about that. So you can absorb the cost and have no price change, or you can split the cost and sort of go up 4% and try and leave it where it is. You hear all of these owners saying, oh, well, we're absorbing it. We're doing our best not to pass this on to the consumer. And I'm thinking to myself, that sounds nice for PR, but that's potentially very stupid.
You'll go out of business if you continue to do that.
That's right. So the only way you could justify it is if you can gain market share.
Yes.
So are you going to buy market share by keeping your prices low? And the answer is, well, you could have done that before. Why didn't you do that earlier? People don't typically say, well, we're buying market share. Big companies do that. You've seen Amazon do that, and a lot of other tech companies buy market share by not passing profits, not having profits, or not passing profits on to the stockholders. Another thing you can do is pass that full markup to the customer. I'm leaning towards that particular solution. And then, of course, you can do inventory averaging. Now, I'll try to explain this. I did have a spreadsheet that I don't have access to exactly. Or wait, do I? Yes, I do. And I think what I'll do is we'll go through the slides and I'll bring that up. Income averaging or inventory averaging is the whole idea that if you're buying and selling merchandise, if you have a retail store, or you're buying most of, say, a manufactured product, you can buy own inventory at an old price. And when you bring new inventory on, you raise the entire inventory to the new price. So we did this in the retail business back in the olden days. And so when the new price of, say, a pair of fry boots would go up, and they would go crazy. I mean, we went from an average price of $24 to over $55 at that time.
Doubling their price.
Yeah, well over double. We did not see a decline in the sales during that period, and that was because there was short supply and we happened to have supply. But what we did do is that we always took the current price and applied it to the existing inventory. So if we got something in, another 40 or 50 pair of something, and we had 20 pair in stock, the 20 pair would go up to the new price. And so you can see that your margin increases there. So, everybody knows the price went up. We got a new shipment. Here's the new price. Everybody was excited when we got the new shipment, but, oh, we're sorry, it's gone up. And what we were able to do there is actually create a sense of excitement and urgency. Yeah, you can wait, but there'll be more next month. So I mean, this is kind of an inflation fact that's what happens, and already people are beginning to buy high dollar items like appliances and so forth, because they know there's a wait and they know the prices are going to go crazy, especially if they're imported. And so as a result, people are pushing forward their kitchen remodels just to get the stuff in and keep the price low. So those are some serious issues as to, well, really, what should you do and how do you deal with these cost increases? Now, putting the numbers to it can be just a touch confusing, but I really suggest that everybody have spreadsheets on these and analyze these SKU by SKU. That can be a really big project for, say, a retailer. But if you use sample products and you kind of just run through those calculations, you may be able to come up with sort of a rule of thumb, kind of make decisions. Should you increase it? Should you not increase it? And then, of course, you have to ask the question, when will they stop buying that particular product? So here's some pricing strategies we can talk about. You can build value into the sale instead of cutting the margin. You can do that through bundling, for instance, by offering dinner and drink pricing on one unit. You get them to buy a little more, but you give them a price break for having bought more. You do bonus gifts that can go along with a particular product that you buy for a good price, and it makes the whole value of the package feel better. You do, for instance, we used to do full ski packages where you would go in and buy the skis, poles, boots, the whole thing, and you'd get a pretty good discount off of that. What happened to the ski shop is they got more volume, they sacrificed some margin dollars, but they were able to sell more merchandise as well. And they were also able to control their inventory, because they might throw the poles might be ones that weren't their hot sellers. So they would get rid of their stagnant inventory along with these packages and not take a markdown later on. That worked out very nicely. Although the accounting can be a nightmare to calculate markdowns by SKU. You can add services for reduced prices where the costs can be controlled. In other words, the services you might be able to control or package in some way that would make the whole thing seem more valuable. You can do payment plans, let them commit to buy it now, pay over time. You have committed to give them a product at a certain price, and that's been around for a long, long time. The layaway concept seems to be coming back a little bit after having gone. Used to be very common, and then credit cards killed that. I see people doing that again. Of course, volume pricing, this is for selling as well as your expenses. Consider how much you're going to need, do better forecasting than you used to do. Don't wait till the last minute, plan where you're going to be. Provide your own substitution products for those that get too high. Now, when we're talking about substitution, this has to do with demand destruction, which is what all the economists are using right now. What that means is people are doing substitution products. Remember when we did our basic economics session, we talked about product substitution. This is what you're concerned about, is that if you're selling a certain kind of widget and the price gets too high and they can easily switch to another kind of a widget, then you lose the business if you don't offer that substitution widget as well. So you have to think that through. If you're a restaurant and your beef prices get too high, then the question is, will they switch to pork? Does that make sense? Will that mess up your purchasing? Does that change your margin too substantially or not? Probably not that big of a deal in a restaurant, because people will just buy something else. But when you're talking about them leaving your business and going somewhere else to buy a product for less money, then you have to be very, very careful about this whole product substitution issue and the prices. When you have that issue, that is when you need to come back and take a look at sharing some of these other strategies, sharing the price increases, for instance. Always calculate your margins to determine how much you can afford. And then, of course, you can demonstrate value with cost benefit illustrations. In other words, salesmanship. Show people, particularly high ticket items, show people what the value is a little better than you have done in the past. So controlling expenses. Now here's one. I gave away the end. Oh no. But yeah, payroll is one I definitely want to talk about because it's the biggest number from many businesses. Do payroll increases more frequently so they know that you're paying attention to cost of living, and don't make them as big. So if you're planning on doing a 6% increase or a 4% increase, give them 1% increases instead. Give yourself flexibility that way. So if you say, we're going to give you a cost of living increase, it's going to be for 2 or 3 months, then they can say, oh, great, that's going to be X amount of dollars. That's going to be better than a, poke in the eye. They may not be happy about it. But for the most part, your goal is to keep your expenses, your payroll growing at a smaller number than your revenue increases. Now, you might say, that's not fair to employees. I don't want to do that. I think most people would say they don't want to do that. But let's remember, there's only one place where raises come from, and that's productivity. So if you want to give them real raises, help your people be more productive. Spend money on equipment, train them better, do a variety of things that will help them get better, as opposed to just saying, oh, here's a raise. Too many times I've seen businesses just go, well, it's 8.5%. We're going to give you an 8.5% increase. And then they expect that increase again next year for whatever the CPI is, or the living, the number is, wherever that is. And it's this entitlement which can end up really backfiring, because if you can't keep up with that, it's really tough. It's a tough balancing act to do the best you can in payroll, yet at the same time to protect the business, you've got to increase your margins. So if you're going to use this concept of allow your business to grow with inflation, by that I'm talking about inflated dollars, but keep your expenses growing slower than inflation, then your margin dollars will increase slowly over time. I think it's a brilliant way to do that. Try things like compensation for performance. Try to, and then do the best you can to beat your landlord up and try to get more from your landlord. If I were going to negotiate with you, I'd say, what can you give me that doesn't cost you very much money?
Well, I'll give you something provided I get something back as well.
Yeah.
So that'll be the negotiation.
Yeah.
You give me some security for longer term. I'll give you a little break on the percentage, but we're going to meet somewhere in the middle.
Yeah, right. And
Right.
You'd be willing to do that.
I'd be willing to do
If some real hard ass came in like me, you wouldn't just throw them out.
If you're
You'd say,
smiling, we'd sit and talk.
Okay. So I mean, I think there are things you can do there. The biggest problem that I see is for some businesses, especially new and fairly young ones, is long-term leases with increased performance contracts, which is, by the way, a tremendous selling advantage to you, because you can say, look, I've got a small space for you. You're not going to look like you've got a lavish office here, yet you're going to have all the technology that you need. And we can be flexible in terms of moving you to a bigger office, and you can move out when you need to.
So contrary to the small office, which we're representing, one of the largest renters of space in the country is based out of Indiana. They do large malls, millions of square feet. And in the middle of the 90s, when things were going a little bit bad, they had very big lease, 50,000 square feet, 100,000 square feet. that they had a very nominal price
Oh,
with a revenue rider on it.
a revenue, right?
A revenue rider. So some of these would come in where you would, if you were a clothing store in one of their big malls, because that's what they leased, the large malls, they ran the entire, they say, okay, we'll put you in there at 50 cents a square foot with a 2% of revenue or whatever that was. And it was
Right.
extremely good for them because they were making bank on the 50 cents a foot,
Right.
okay, covering their costs. And this guy, if he really did well, he was going to, the 2% was going to represent a lot more than 50 cents a
That's
square
right.
foot.
That's right.
But
And-
it limited the risk.
well, it did. It limited the
And it
risk
shared it.
and it guaranteed margin
Absolutely.
because you did okay at the small end.
So this was a
and you
win-win.
Still did okay at the
Right. The
larger
guy
end.
going in there could say, okay, my landlord's treated me right. We're going to
Yeah.
bust our butts and we're going to do it.
Right.
And the landlord's like, hey, this guy is really going to do it. We're going to get a,
Right.
and it was a win-win.
Yeah. Absolutely.
I don't want to do that because obviously it's a form of taxation in a kind of way. If you take it up the scale to a city, that's what the city tries to do.
Well, with the city,
What is it,
yeah,
right?
yeah, they
So
do.
it's a modified form of that. But, I don't want to go and ask you, well, Ron, what were your sales this? I need to audit it.
Yeah.
I don't want to do that.
Well, right, and that ends up being kind of a mess.
And how do you know what the
And
2% is?
I've been through those audits before. They're nasty. They are nasty. And
Yeah.
many times they don't believe you and you're going, wait a minute, I have impeccable records, and you have to prove that you have impeccable records. So anyway, I think our point here is very simply is like, don't freak out.
Great visual.
The inflation strategy can actually be used to do better. I'm not suggesting that everybody can be better if they use this strategy, but I'm not guaranteeing that, but I suggest that it's possible that you can actually end up in a better place than you were. And at minimum, if you do it right, you should be able to at least stay the same and have a little bit of a nominal growth. So there we are. I want to throw it open to you other guys and see if there's some questions about all of this.
Well, I'm in the same room, but I don't know if the camera will switch over my way. I did have a question when it came down to fighting inflation on the restaurant industry.
You're muted. Ed.
Oh, I'm still.
Okay. You're right.
Yeah, it's still coming to the same audio. I guess the main question is, I just ran into a scenario where one individual was piled up on ingredients that wouldn't go bad for a long time due to the rise in prices. They got audited recently, and they got dinged because they said that your expenses did not match your sales, although it was all pure inventory. So I'm assuming at that point is that because how the internal accounting is not being kept, only the accounting meant for taxes, that the IRS said, okay, well, we know that's inventory, but you consider it as an expense at this point, not an asset or as retained like inventory. So you owe us $30,000 worth of back taxes because we think you didn't report everything on sales.
Wow.
That happened. So I don't know what
You
this.
take that one.
I would actually have my accountant see if he can reclassify that investment that he's got. He bought it, put it there, and reprocess it in a way and go back to the IRS guy and say, look, this is kind of like a loan. We've purchased it, we've got it, and it's not our cost of operations. I'd go down to accurate cost of operations versus this artificial present condition that we're under. I think that could be debated.
Yeah. And I was asked for an opinion. It was like, I think that means you need to have your own balance sheet and profit and loss, so you can go and fight and show that that's an actual on the balance sheet.
It's a legitimate expense for a future income.
That's
But
right.
they're going to claim it as, it's a taxable event. And so, I get why they're doing it, but they don't know the full picture.
Yeah. And of course, having accurate books and good financial statements, that's what of course, Ed always says is that you've got to have it accurate. And keeping track of individual costs down to the detail level appropriate is the way that you're able to pull those numbers up without completely reformatting everything, going through every receipt and every purchase to try and.
Got it. No, he was trying to fight inflation and then boom, got hit with with that.
Yeah.
So
Well, and I will say, I mean, I'm not sure this is exactly to the exact point, but if you really get crazy on, say, commodities, and you start buying commodities that you plan on using for future production, you might want to have a conversation with your tax person about that. Now, I know that, at the dairy, we are doing these kinds of things right now. We are buying things that we know we're going to need. I'm looking right now for paper, because finding paper seems to be a problem. And so we use a reasonable amount of paper. We print 30,000 pages a month, and that's going to end up being a lot of money over 12 months.
Sure.
And so the question is, well, are we going to be able to get all of that paper? And are we going to be able to pay a decent price for it? And the answer is, well, if you buy it all at once and you store it someplace, as long as the storage isn't crazy, you're going to be able to maintain the expense at that lower value for a full year. Well, then you go, well, how about 2 years? How about 3 years? How far does it go? And I think that you may have an inventory taxation problem in a circumstance like that. However, it's possible to shift. In this particular case, the printer is going to have the paper. And I don't know where ownership exactly will be on that. You guarantee a certain thing, and you do have costs associated with carrying that.
So what this indicates is inflation does bring up a different set of business skills.
Yes.
That then can and need to get taken into account. I have an associate that I know who specializes in buying futures, and he's done it for 20 years. And he actually buys a thing called mill run. Now, mill run is what comes out of a flour mill that is thrown away, and it's used in a dairying process for feed. It's just the husk and.
Yeah.
But it's actually of quite value. But the problem with it is that the cost of the flour is going up so fast. Therefore, the off product is going to go up in proportion to the cost of the flour.
Yeah.
But the need for the mill run is still there. So how do you do it when you're signing 6-month contracts? How do you do that?
Yeah.
So the model that they use, and this is a commodities trading model, they have to buy it based on the cost of the flour of the day. And so he's already pre-committed, understanding that he's also now pre-selling it, never touches the product. It's,
right.
Rail car loads of it.
Yeah.
It's a whole, now it is really a financial spreadsheet risk and reward deal.
Yeah.
So that's an example of how he can survive it because he has enough money to back him up to do it.
Yeah.
Some of the smaller guys who are doing that, it's too high stake poker for them.
Well, and it has a lot to do.
And they drop out.
Yeah, it has a lot to do with your cash and your
risk aversion.
Risk averse, yes. With the dairy, we bought some gasoline futures with the idea that gas wouldn't go up as much and we wouldn't have to raise prices. But that didn't go very well because the prices of gas came down during that period of time. So they ended up losing money, on the commodity buy.
But you stopped the exposure that you were worried about.
That's exactly
right.
And so, I mean, it solved the problem of increased prices, but it ended up costing them a little bit more than they thought. Now, had they held those a little longer, they would have, and if they were doing it right now today, say in the last 3 months, they would have made a huge amount of money because oil, price of oil doubled. They're now having to pay the price for that additional gasoline and across all their 40 trucks. And that's a big number. That's a pretty big number that they're having to pass on to their customers in one way or another. They typically make price increases once a year. And so, we were just getting ready to do the brand new price increase. And I think it was a price increase of about 4%. It's like, whoa, wait a minute. We can't guarantee that these prices are going to last for a year anymore, because we have got to have the flexibility to raise prices given what happens to the rest. Yeah.
There's another thing that I've noticed, at least in the restaurant industry with inflation, is everybody's kind of going away from the traditional menu. They're finding alternatives on how to just print their own menus from their restaurant, because it takes 2 months typically to get a batch of new menus. And one of my customers, he's much better with his numbers. He knew he lost money in 2 months just because he went out of the country, came back, and all of a sudden he realized, wait a minute, I'm negative on these 2 months. Like he felt it
just because he didn't change his prices fast
just
enough.
because he didn't change his prices
Yeah.
fast enough.
Yeah.
And
Well, the electronic menu is certainly one way to manage that. There's the customer side. You have to consider the experience a little bit.
yeah,
Some customers are accepting that as kind of a new reality.
the QR code.
You got to have a cell phone, and you got to, all of that in order to be able to get it. And what they're presenting on a cell phone as their menu is not nearly as desirable as how you can sell off of a real menu. But those are all considerations and opportunities to save money. Yeah.
So cash in times of inflation. True story, if you have access to cash in times of high inflation, you have the access to make some transactions that you previously could not do. New Zealand, America, there was a time in the 90s where the inflation in America had been in the 21, or the interest rate, sorry, it was 21. It had dropped back down and was getting down to the 4s and 5s again. However, New Zealand was still in the 21. So what had happened is New Zealand in the late 90s, the interest rate for commercial paper was above 20%. Companies that were making 5 or 10% profit were going out of business. So if you had a source of cash, you can go to America, borrow money at 5%, take it back to New Zealand, and you can actually turn companies around by buying 51% control, and their 21% paper disappears to be 5% paper, which you happen to own. And now you've got a company that survives. And by the way, your competitors are dying. New Zealand lost over 50% of its businesses in a period between 70 and 90. They went out of business.
Wow.
They turned because of the government single-handedly changing the tax rates for import tariffs and inflation and the index for money taking off. It was a disastrous and textbook case on a combination of inflation and interest, killing the business economy.
Right.
But there were people who saw it and who could use money from overseas. And this is, of course, overseas investment comes in and can take advantage of that. And then they end up owning the majority of what's going on.
Yeah. Those are scary circumstances.
But yes, but we can actually do it here. If we can get control in the early stages of business, it's hard. You normally don't have any cash on hand. As you're more mature, if you can wait one of those 10-year cycles, it's going to happen. And you can have a little bag of cash and some credit and not be highly leveraged, then that presents an opportunity at some point.
That's exactly right. And we've had these conversations about cash in the past, and this is one of the reasons to have cash. Is to be, now you would argue a couple of months ago, yeah, but I've got cash, too much cash, and it's devaluing every month. And
but that's offset by hopefully the opportunity that will come back.
That's exactly right. But then you could also say, well, but you're only going to make 2% on your cash anyway.
Right.
So who cares?
Who cares?
Have enough cash to be able to take advantage of the circumstances. And now we have circumstances, a lot of circumstances that we can take advantage
Well,
of.
and there's one last thing that came to me too, is when you're in business with somebody else and you walk into a high inflation time or a time where it is difficult times, if you are unequally yoked, kind of a biblical phrase, but let's talk about if you've got somebody who is really well established and can weather a bad time, and you're sitting on the front end, kind of living day by day and really committed, when push comes to shove, you're going to go underwater. and the other person's going to survive.
That's exactly.
You got to be
right.
really careful who
Yeah.
you're in partnership with.
Yeah, that's exactly.
And
right.
likewise, if you have a bank who is nervous,
Mhm.
I had a bank, big bank, that I've got rental property, and we had a high 7s credit score, and they just simply said, we're not going to do lines of credits anymore. And I had more money than the line of credit was in their bank,
Yeah,
and I had a high 7s credit score, and the bank said, we're just canceling we're not renewing any of our line of credits. And that was 2010. And that's,
and
well, that's
that gives
one of the
that,
biggest banks in Southern California.
and that gives you a
So
kind
my
of-
partner wasn't with me.
yeah, and that gives you an insight as to how strong they are. How, I mean, if they're concerned,
They are concerned.
yeah, and it's like, wait a minute, there's a whole lot of people we don't want to loan money to. So
Right.
many, we're just gonna have a policy that we're not going to do that anymore.
Right.
You really have to go, well, they don't believe in the
They don't
economy.
believe in the economy.
That's right.
We went to a smaller local bank who had a look at the book of business and said, oh, you're unleveraged, relatively speaking.
Yeah.
And you have a good credit score, sign here.
Right. That's right. And that's why you have to shop around. And that's why you have to
yeah.
be, you got to be tough in these times. You can't be timid about how you spend money, how you set your prices, how you analyze, your business. You've got to be all there and really looking.
Picking your teammates, knowing who you're traveling with,
Yes.
having good partners for good decisions, but also who can afford to bring an extra bag of water when you're entering into the desert.
Yeah.
That's a good thing.
Yeah.
Yeah, that is good. And that's a good example to end on. So thank you very much. I thought this was a good discussion, and I think it's one that a lot of small business people will find beneficial. We will look forward to having you all at our next meeting. Thanks a lot.
Thanks, everyone.
You bet.
Bye, John.